Hello, welcome back to our Climate Chamber Mission Sessions. I'm your host, Clare English. We've had some fascinating insights so far, and the momentum keeps going after that lunch break. We hope you're all feeling a bit more energized and refueled. Before we go any further, some big thanks owed to our wonderful sponsors without whom this hybrid Climate Chamber mission would not have been possible at all. The Scottish Government, Scottish Leather Group, City of Glasgow College, Edrington and Scottish Water, and of course the British Chambers of Commerce. Now keep posting your comments and observations to us on the chat in Hop-In, and use your social media tendrils too, if I can get my teeth back in, at Glasgow_Chamber and hashtag Climate Chamber Mission. The next session, I should warn you, is a little bit shorter than we anticipated for various reasons, but we just think 45 minutes, that's what we'll do. We'll nail it in 45. I'm about to hand over to John Curtis, who's going to moderate this session, one of our sessions called Green Finance. Let me tell you a little bit about John before I do that. He is the founder of Curtis and Associates, a company researching the implementation of blockchain in the energy sector. He's also the founder of the Petrolink Group, which specializes in data acquisition and management solutions for the upstream oil and gas industry. There are two separate Curtis and Associate Group companies joining the Climate Chambers today and tomorrow. First, there's PT Goldteak, part of the British Chambers of Commerce in Indonesia delegation. And secondly, we have the New Energy Matrix, an Italian registered company, which is part of the delegation from the British Chamber of Commerce for Italy. It's building an open, decentralized ecosystem for monitoring and management of net zero commitments and progress. So John, it is over to you now, and you're not alone. You've got some impressive guests on the way.
Good afternoon, everybody, and thank you for joining the session today. I'd like to first thank the Glasgow City Council, the Glasgow Chamber of Commerce, and all of you here today for making this panel session possible. I myself do not have a background in the finance sector. I'm instead a data management specialist within the energy industry, in particular solving the problems of the gathering and sharing of critical information between project owners and their supply chain co-venturer partners. I've been looking closely at the complex landscape that exists for the setting, recording and progress of net zero targets in multiple interconnected business sectors, especially the challenges of the analysis of Scope 3 emissions. One of the delegates pointed out to me this morning that Scope 3 is really only someone else's Scope 1 and Scope 2. But until everybody is posting their Scope 1 direct emissions, much confusion and opportunity for greenwashing will continue to stand in the way of true and fair decarbonisation. Fair and accurate reporting of carbon footprints and net zero progress is a very relevant concern to those who shoulder the responsibility of placing green finance resources. With that in mind, I'm very pleased to introduce our panel today. I would like each panellist to please give our worldwide audience a short précis of themselves, since we have actually not 45 minutes, now 40 minutes left for this session. I'll start with the list that I was given. So Jamie Butterworth of Circularity Capital, would you please introduce yourself briefly to the audience?
Thanks, John. Yeah, so Jamie Butterworth, I'm one of the founding partners of Circularity Capital. We're a specialist investment firm specifically targeting investments in European growth stage companies operating in the circular economy.
Francois, our live panelist today, please would you go next?
Thank you very much. So my name is Francois de Maricourt, and I am here today with two hats. The first hat is that I am representing the British Chamber of Commerce of Indonesia in this panel. And the British Chamber of Commerce of Indonesia has been set up more than 40 years ago, has more than 260 members, and with all the British iconic brands, as you will expect. But my second hat is I am also the CEO of HSBC in Indonesia. HSBC has been in Indonesia for more than 130 years. We have more than 3,000 staff, and we provide quite a lot of finance, including green finance that we'll discuss today.
Jeffrey Chattelier, also calling us from Indonesia. You're next, please.
Yes, thank you, John. My name is Jeffrey Chattelier, and I'm the CEO of Forest Carbon. We are a company that specializes in the restoration and conservation of tropical forests. Based in Indonesia in 2017, we secured an impact investment from London-based Mirova Natural Capital to launch the Sumatra Marang peatland project, which is one of the world's largest peatland restoration projects covering an area of 23,000 hectares, which is roughly 3.5 times the size of the island of Manhattan and also larger than the city of Glasgow. Since then, we've verified over 1.7 million carbon credits using the Verra International Standard. And we've sold those credits to global corporations such as Chanel, L'Oreal, AXA, London Heathrow Airport, Mott MacDonald, and Zalando, to name a few. And building off of the success of our investment in the Sumatera peatland project, in 2020, we secured an investment from AXA Investment Managers, also based out of London, to expand our business and build out a portfolio of projects focused on restoring and conserving nature here in Indonesia. You know, at this COP, it's really great to see the interest of all the stakeholders coming together, looking at investments into nature, and we're really happy to be here. Thanks.
Thank you, Jeffrey. Bruce, a short précis, please, of your involvement.
Right, thank you for the invite, and I should start by mentioning that I learned yesterday that we both started in Glasgow about the same time. We opened our first branch here, RBS branch, in 1783. In fact, David Dale, who went on to be your director at the time, managed the branch for us, so we've got a long history of working with your members. Obviously, NatWest has taken a lot of action in this space already. I won't repeat what Katie Murray covered this morning when she was with you, but last year we were the largest lender to renewables in the UK. In terms of my role and why I'm here, I basically have the regulatory responsibility for managing and evaluating the risks that come from climate change. We carry it as a top risk on our radar, have done quite a bit of stress testing and scenario analysis. We're building it into our credit criteria, and also looking at the reputational and the disclosure risks that come with climate change. Really pleased to be here.
Bruce, you're looking pretty good for 1783. So I'll move on to Rahul. Rahul, I believe you're calling in from Singapore.
That's right, yes. So great to be speaking to you and the rest of the panelists. So a quick introduction to what I do. So I work with Standard Chartered Bank. I'm based out of Singapore, and I globally head their sustainable bonds practice. And in my role, of course, I advise issuers or borrowers of green finance, green and social finance, I should say, given the numerous colors of ESG labeled financing that we've seen over the years. So a core part of that is speaking with or advising borrowers, speaking with investors in terms of the latest trends, and also, again, rounding it up with the regulatory work streams, because as you know, taxonomies and development of various guidelines is kind of at the heart of any kind of green financing that we see today. And really proud to be working with Standard Chartered. We, as a bank which has Asia, Africa, and Middle East at the core part of what we do, and as a primary funder for emerging market borrowers, we do endeavor to get capital, which is both solving green and social issues to countries that need it the most. And most recently, kind of late last week, we announced our interim targets on net zero, so a 2030 set of targets to provide a view into how we would look to scale down both scope 1 and 2 as well as scope 3 going forward. So really happy to be here.
Rahul, and that concludes the introduction to the panel today. And moving on to the panel questions, instead of asking each panelist to respond, and bearing in mind the shortened time for this panel session, I propose instead to only get responses from perhaps 2 to 3 of the panelists for each question, so that we can broaden these important discussions as much as possible. So I'd move on to the first question. Much is spoken about the circular economy, and we can congratulate those engaged with the local initiative Circular Glasgow, which we have heard about much this morning. So, the first question, what does the circular economy mean to some of our panellists? Jamie, I'd like to put the question to you first, please.
Yeah, sure. So to put things into context to the event that we are surrounded by, to date, efforts to tackle greenhouse gas emissions have focused primarily on energy generation, the shift to renewables, and on energy efficiency. But that actually only accounts for around 55% of greenhouse gas emissions. The remaining 45% comes from producing things like cars, clothes, food, and the other products that we use in our lives. And if you look at the way that we create value through that part of the economy, it's very linear. We typically dig something out the ground, turn that into a material, into a component, into a product, use that product for an increasingly short period of time before throwing it away. And that linear take, make, dispose economy is staggeringly wasteful. So just take one example, take the computer I'm talking to you on, or the mobile phone that most of you guys have probably got in your pocket or on your table. We throw away globally 1 cruise ship a day of IT products, for example, with a massive environmental impact and also a massive financial value loss. Food waste, we throw away a third of all food produced, would be the world's 3rd largest greenhouse gas emitter, behind only the US and China, for example. What we're now beginning to see is a growing number of businesses using circular business models to grow faster, to develop deeper margin products and services, and to build more valuable companies effectively. And typically when they're doing this with a resource productivity gain, which is providing a financial return alongside a measurable positive environmental impact. And that's why a lot of companies are now starting to rethink their product, service, business models through the lens of the circular economy, where we see this very collinear impact between financial value generation and positive environmental impact.
Jamie, I forgot to add earlier on that if any of the panelists attending remotely did wish to comment on any of the questions, please just raise your hand and I'll bring you in to answer the questions. I'd like to bring Francois in early in the conversation, as he is one of our live panelists today. Francois, do you have any comments about your interpretation or the HSBC's interpretation of the circular economy, please?
Yes, I think that's a very good comment what was made by the previous panelists, is to say that quite often we focus on all the carbon emission coming from energy, from cars. And so for us, for instance, in Indonesia, the focus is really around the electricity production. And so for that, there are a lot of projects in order of moving to more renewables, and it's very visible. But one part that is less visible is around the circular economy and the recycling. I think it's also an area where financing has a role to play to scale it up, because quite often what we see is that it also requires investments. Quite often the scale is not there. And so just to give you 2 examples of what we are doing in Indonesia, we are giving some green trade finance to 2 companies. One is called PT InnoCycle Technology Group, and the recycle PET bottles. And the second one is PT Metito Indonesia, and it's about water management. And so I think that it's really important that we look at both sides, the new emissions, but also how we can help to recycle.
Thank you, Francois. Unless there's any comments from our other panelists, I'll move on to the next question, please. So, many companies are promoting their green credentials, but greenwashing exists in many forms. I myself have heard of carbon avoidance, carbon leakage, zero counting, and double counting, of course, which most of us have heard of. There seems to be no universal taxonomy for the evaluation of carbon footprints and net zero credentials from the perspective of green finance. And multiple standards exist across different jurisdictions worldwide. I'm interested in what investors and banks are looking for in evaluating green projects and company credentials. So Bruce, can I please start with you?
Sure. Why don't I start with the company credentials angle? And we just finished our own stress testing, and we understand the risks that are coming from climate change, and we think probably everyone's in the same boat. So when it comes to credentials, it really comes down to your action plans, what work you've done to understand your climate risks, the actions that you've laid out, transparency around those actions particularly is important. I heard a panelist here yesterday with the CEO of Microsoft on one of the events here in the Blue Zone at COP26, and he really talked about credibility. And basically, if we all make these commitments, but we don't measure them properly and aren't transparent, then all of this is for naught, and you get quite a bit of cynicism. So for us, it's really around transparency, openness in what you report, and that will add a lot to your credentials.
Thank you, Bruce. I'm interested to hear that you managed to get access to the blue zone. It seems to me that net zero is unlikely to happen unless there's a very close cooperation between business and government, and there really ought to be a zone where we can all sit together, I think, because we're in separate zones at the moment, and this separation is certainly not good for the common humanity drive towards net zero. Anyway, perhaps they'll do something different for the next COP. So, Rahul, I'd like to move on to you. From your perspective in Singapore, how do you believe green investment criteria can be met?
Yeah, no, absolutely. That's a very pertinent question, John. So when we look at greenwashing, and I'll extend greenwashing to green and social or sustainability washing, the broader ESG washing, as we call it, that has obviously been around since the day we saw green financing take into effect. We do realize that as much as green is about showing your credentials in the ESG space, it also comes with a sort of a sense of responsibility to ensure you get it right and you set the right precedent for various markets, within the country, within the region, so that other following members can actually do the right job also. So what we've seen across, you mentioned taxonomies and standards, so there has been sort of a number of regions or countries that have come up with what they believe is the right standard for green. The EU standard, of course, the EU Green Bond Standard, of course, is one of the most comprehensive in this regard. It's taken a lot of years of work, but nonetheless, we have seen, for example, China has its own green catalog. We have green taxonomies out of Japan and out of various ASEAN nations who are somewhat on the road to getting there. So what this means from an investor point of view, which is where we really start, which is where really the buck starts and stops, if I put my financing hat on, is that we really need to solve for something that works for the investor at the end of the day. And most investors, they like simplicity and they like something that they understand better. So effectively having a number of standards which conflict with each other never sits well with any investor globally. Typically, what we've seen is investors tend to gravitate towards one standard which they believe one is probably the most comprehensive, but also has probably the maximum buy-in from the number of deals that they see in the market. So currently, we do see the EU standard as one of the more comprehensive ones, and 50% of the green bond market or the ESG bond market is effectively European issuers. So we just hit about $850 billion for the first 10 months of this year, which is a record, year-on-year record. But 50% of that comes from Europe, and even Asian investors, Asian borrowers and Singaporean borrowers, when they come to the market with their financing deals, in many cases they are also vying for a lot of European funds to partake in their transactions. So what that effectively means really is that there is going to be a pull towards harmonization. We have seen that happen with China and the EU, where there's sort of a bit of a common agreement where effectively, there's the common taxonomy which works equally well for both China and EU, and that allows two of the biggest blocks to issue as much in big numbers and sort of galvanize and grow this market further. So clearly, I think greenwashing is well understood, and it is something that's being tackled. And one other point around this market is that you do have an independent valuation agency, which most of green finance, investors do again look towards to evaluate these transactions on the ESG credentials. So it is also being talked about to regulate some of these evaluators so that there can be again more harmonization in the way they evaluate and their rating systems, etc. But I think we do understand what this means for the market, and the market is moving in the right direction for now.
Hey, John, if I could just jump in on that as well. I think the two other elements to add, one would be around green credentials would be publishing Scope 3 emissions as well. I think we heard that from Unilever's Dave Ingram. I think that's quite important for companies to do. And I think also having credible transition plans. And there's not been a lot of discussion about that, particularly for those of your members in higher risk sectors. having a plan that really clearly lays out to all of your stakeholders how you're going to be dealing with climate change really will, I think, bolster your green credentials.
Thank you, Bruce. Francois, I believe you wanted to comment as well.
Yeah, absolutely. So I think that, John, you mentioned the partnership between governments and private sector. And I think it is, of course, critical. But also I think that within the private sector, it's quite important that we build some global partnerships to reach these global standards that are really important to avoid greenwashing. And so in the banking industry, there are several initiatives that have started. One is the Financial Service Task Force by the Prince of Wales, Sustainable Market Initiative. And the purpose is to develop industry-wide common standards to measure the sustainable finance with the support of 11 other banks. You have also the Net Zero Banking Alliance. It's a group of 58 banks chaired by Mark Carney, as you have probably seen. And so also the idea is to see how we can have common standards. You have also for infrastructure project, another initiative called Fast Infra Label to once again make sure that there are some consistent global standards. And then the last one is a task force of a natural related financial disclosure. And so what I want to say is that already there are quite a lot of partnership with the global banks, with a lot of financial institutions, because it's really important that we have this common standard to avoid greenwashing and make sure that when we make some disclosure, it's following the same standards, so there is some consistency.
Thank you, Francois. Unless there are any other responses from the panelists, I'll move on to the next question, please. So we have here today an excellent representation at the Climate Chambers from Indonesia. And as one of the participating companies from BritCam, I would like to thank them for their considerable contribution today. As a leading emerging economy with a declared national net zero target, Indonesia is a wonderful opportunity to invest in green projects with a strong ESG element. Francois, as the representative from HSB in Indonesia, would you please tell us about some of your plans there and in the Far East region as a whole?
Yeah, thank you very much. So to start with, we see a lot of opportunities in Indonesia, and so we are quite optimistic about the Indonesian economy, and we expect the growth rate to be roughly 5.2% next year. At the same time, Indonesia has been very clear that they want to prioritize all the net zero initiatives, and the President of the Republic has made it his priority to really reach net zero by 2060. Yesterday, he was meeting with some of the biggest British companies, and he reiterated that he wants to see some investments there. So the government is doing things like having a sustainable finance task force. They are starting an emission exchange mechanism, and it seeks to implement provision for carbon emission taxation. And so the new tax law includes for the first time a carbon tax, which I think is a very positive step. And the third one is investment in renewable. And so the idea is that 56% of 440 gigawatt of new power plant will be based on renewable. So for us at HSBC, we support these programs in different ways. One, we have set up all the framework for green bond and green sukuk for the government back in 2017. And the government is issuing a lot of debt using this framework, this green framework. And the last one was earlier this year, $750 million green sukuk by the government of Indonesia with a tenure of 30 years. So a lot of investors want to invest in green products. We are also financing green infrastructure and social infrastructure, like a recent satellite that will help to have for remote communities and access to communications. And we are also making sure that we support our clients in their transition plan. So we have a group of experts and we engage with our clients, and the idea is to help them to move into the transition to net zero. Because what we are seeing is that a lot of companies in Indonesia, like in a lot of developing countries, and they have good intent, they want to do something, but they don't always know how to do it. And so they will expect their banks, their partners, to help them. And I think that with our global scale, with our expertise, we are here to help them. And instead of saying, oh, this we do, or this we don't do, we are trying to work together. It's okay, right? What can we do together? And in this respect, we have recently set up a joint venture with Temasek of Singapore. And we have put $150 million of capital with an idea to raise $1 billion of financing in order to support sustainable finance in Southeast Asia.
Thank you, Francois. With my apologies to the panellists who don't have any connection with that part of the world, I will actually ask Rahul if he wouldn't mind commenting from his own perspective at Standard Charter. Could you explain to the audience how you are engaging with green investments through green bonds yourself, which are leading to the ESG funding space?
Yep, no, absolutely. Again, when Francois did mention about the Republic of Indonesia green sukuk, which also Standard Chartered has been proudly been a part of, and also when it came to COVID funding, for example, early last year. Again, it's been our pleasure to be advising on the $4.3 billion sukuk funding that was raised to fight or to fund the COVID budget. So a lot of what we're doing is really focused on emerging markets and markets like in Asia. A good amount of focus is going into advising our borrowers in terms of transition finance, and what that is sort of the critical piece of the puzzle as we see it today, because a number of our existing exposures, and this is true for most banks who do bank emerging market clients, a number of our clients are sitting on assets which might be stranded in a few years from now. And they will need opportunities to diversify their asset base. They will need opportunities where funding might dry up because they might be seen as loss leaders in terms of the kind of assets that they're playing with. So a lot of our time now is being spent with some of these companies in the harder to abate sectors, in sectors which, where globally, most financiers are sort of setting targets to sort of slowly diversify out of. So the idea is, yes, it is important to diversify out of these investments, but at the end of the day, these are also companies that are employing a number of people, supporting a lot of livelihoods. And at the end of the day, to keep business alive, it's important to actually provide the kind of advisory that they need to slowly start branching out, diversify the revenue sources, and move into sources which can be more sustainable going forward. So as part of that, we do a lot of technical analysis on temperature ratings of companies that we have large exposures to, and help them. That helps them in their transition plans because it helps them set an understanding of where they are today, and effectively we all know where we need to be in 2050 or 2060 or 2070, depending on which country we're talking about. So how that sort of next 10 to 15 or 20 years needs to pan out, that planning is something that we are focusing a lot of time on, and we do believe that also is something that gives us a lot more new avenues or opportunities to bank existing clients and do more with existing clients, going forward.
Well, I think we all certainly hope that the governments of the world will be releasing more finance to economies and countries which are very vulnerable to the impacts of climate change. So investments in the ASEAN nation countries certainly appear to be growing very quickly in that part of the world. My own group launched a net zero target back in 2005 at the time of the Kyoto Protocol. And through the establishment of an agroforestry project ourselves, we on degraded land in Sukabumi province, West Indonesia province, we managed to reach net zero by 2020. We're very proud of that. And we actually managed to do that at a cost of less than 0.3% of our group turnover, which goes to show that saving the earth does not need to cost the earth. As an existing investor, I'd now like to bring in myself, our fifth panelist, finally, Jeffrey. You've been waiting a long time to come in. Jeffrey is the founder of Forest Carbon, a noble project which is restoring large areas with multiple carbon sequestration projects. To finance Forest Carbon, you've needed to attract investors, of course. Can you please tell the audience about the challenges that you faced raising that finance and those that you still face today?
Thank you, John. Yeah, when we look back at 2017, when we were looking to launch our project, there were a lot of opportunities to seek financing. And one of the reasons for that is because the risk profiles of natural climate solution projects just really didn't match, the profile of traditional investments from the investment community. Some of the reasons for this is, there were very few projects that had been working for a number of years, so there was a lot of implementation risk. There was significant regulation uncertainty, and of course, the financial risk. And so as a result, we had to focus on targeting the impact investment community. These groups had been investing in these types of projects. They had brought on subject matter experts. So they had a much better understanding of investments related to tropical forest restoration and conservation. And also they had the mandate to take a bit more risk than some of the traditional banks and some of the representatives on the panel today. But over the past 10 years, the sector really has matured. When we look at ASEAN as a whole, there's already 12 certified projects covering 1.3 million hectares, 16 million carbon credits a year. So it's, it really starts to indicate that, the sector is maturing. Investors can see that there's a proven track record and that it's possible to protect these large forest areas, that create multiple benefits across society and for communities. And then, importantly for the investment communities, that they generate financial returns. And, over the past 24 months, we really have started to see a shift in interest in investing in nature. And a lot of that is coming from the fact that, major corporations, as you've heard, are making net zero commitments that are really driving the demand for environmental services in the form of carbon credits from these projects. And so, a few years back, companies would buy, 1 to 2 years worth of credits. Now they're starting to enter into long-term offtake agreements, which are giving a lot more security to projects. You can also lock in these contracts prior to seeking investment. And this is giving a lot more confidence to the investment community. And so the opportunities for attracting investment are much higher. And so, as I see more traditional financial institutions coming into place, our company ourselves, we took an investment from AXA Investment Managers. I think, that's, a signal of where things are going. And as groups like HSBC and Standard Charter come into play, it's really going to be a good opportunity for investing in these types of projects in Indonesia specifically, but also across the ASEAN countries.
Thank you, Jeffrey. Banks and other investors looking to invest in carbon sequestration projects have to have full confidence that their funds are being placed correctly and that the associated greenhouse gas emission offsets are being calculated accurately and honestly. There is an implicit risk in these investments. So Bruce, if I may return to you and then to Jamie afterwards, risk management is an area in which you are directly involved. Can you comment on how NatWest Group are approaching these challenges?
Sure, thank you. I guess first is understanding our own risks. That's really informed our thinking when we work with clients. And Bank of England has been pretty progressive in this space and really requiring us to embed climate risk management in everything that we do. So some of that involves stress testing, scenario analysis. But a lot of it also has to do with understanding transition risk, and which is really then the transition risks that you and your members are facing. So how will the regulation change in your sector? How will customer preferences change? How will the competition change? It was already referenced stranded assets as a potential risk, ultimately loss of revenue. So we're basically doing our own analysis, breaking our portfolio down into sectors, our client sectors, which are the most impacted, who we think will be the winners and the losers. And actually, when we're working with companies now, we've created a qualitative scorecard. We're having relationship manager conversations with clients to really understand, do companies understand, do each of you understand what the risks are due to climate change? What is your transition plan? How quickly can you get there as well? And especially if you're a high-risk sector, do you have a credible transition plan, as I mentioned earlier? I think the other aspect that was around opportunities, massive opportunity here. One of the things I found in the different sessions here, John, is just the optimism around opportunity. Businesses, NGOs, scientists working together, coming up with client solutions. There's a massive opportunity here. We think it's more than 100 billion, even just for SMEs in the UK, one little small part of the economy. And it's really, are people taking advantage of those opportunities? Because ultimately this will affect everyone's business model. I would liken it to the same way our company is dealing with Brexit, the same urgency that they dealt with Brexit or that they dealt with COVID. They should be doing the same here with climate, dealing with the risks, but also really embracing those opportunities. That's how we'll be evaluating, the companies that we deal with.
Thank you, Bruce. This question of risk for the placement of funds and the probable release of more funds from governments to economies and countries that are directly impacted by the severe effects of climate change is something that's very important, I think, to the entire banking community. So I will ask all of the panelists, if I may, one by one. So Jamie, your opinion, please, on risk and how you respond and your customers might respond to that, and what sort of information do they need to have the confidence when they're placing their funds?
Yeah, and just to be clear, because obviously everyone's operating in a slightly different part of the finance ecosystem maybe. So we are raising capital from institutional investors, family offices, and then we're investing in a portfolio of 10 to 12 businesses that we would hold our investments in for 6 or 7 years, right? So this is long-term investment into private companies that we're seeking to invest in. So we are able to, in that process, go pretty deep on what we like and don't like in the circular economy. So we're only investing in businesses in the circular economy. We're only investing in businesses where we can see a measurable positive non-financial impact that's quantifiable and that can be third-party assured. Okay, so in doing so, we're looking at maybe a couple of hundred companies for every one that we decide to invest in. And our job is to get good at understanding the attributes of what we like and what we don't like, of identifying those that are going to be highly impactful, but also meet the right risk-adjusted returns type criteria from a financial perspective. So to put that in context, every investment that we make, we write a theory of change document. We look at which circular business model the company is using. We look at why we think it's going to have that positive impact, what's driving that, are there any potential unintended consequences, how will we measure its impact, what do we expect it to be during the investment period, as well as the ESG factors. And I think the ESG factors are also a kind of important hygiene factor in terms of making sure the companies have the right policies, procedures, and approaches. But I think the key point here is also trying to find companies where the more they grow, the more positive impact they actually have. So for us, our job is to do that on behalf of our institutional investors and make sure that they understand the risk profile of those businesses and we're getting them the right risk return on their investment.
Thank you, Jamie. I was at the pre-COP conference a few weeks ago in Milan, where the British Chamber of Commerce, Italy, were hosting the events there. And Francois, I met the HSBC manager there, and we had quite a long discussion about the risk. And he mentioned that there was a concern at the bank, how to identify the risk of a particular investment. How sure could they be that the project even existed? Maybe you'd like to add on to your colleagues' comments.
Yes, no, absolutely. I think that because it's a huge transformation, then it means that the whole landscape is changing, and we need to review how we assess this risk. So we are working quite extensively on it to try to understand this risk, because that's something that is moving very fast. And you have a direct risk, but you have also the reputational risk. And there are things that you just don't want or you can't do anymore. And you have to future-proof your bank and your business. But having said that, I think that my focus will not be that much on risk, much more on opportunities. How we can really support businesses, help them with transition, engage with them. And for instance, at HSBC, we have committed to provide $1 trillion of sustainable finance in the coming few years. And we have already done 87 billion. And so I really think, as Bruce was mentioning, that there are a lot of projects. There will be a need for a lot of investment, and governments cannot do it alone. We are here to support them. I think that all the financial sector, all the banks have a critical role to play to finance these green initiatives, and it creates also some opportunities.
Thank you, Francois. I'm sure that Jeffrey is very pleased to hear the bankers saying that it's all about opportunity, perhaps, and the positive note that to seek out opportunities and to engage with the communities, and of course the ESG element, very important to help the local communities in their own struggles against climate change. So Rahul, I'll just finish with you on that. From your perspective there, obviously risk is a matter of much concern to Standard Charter. Perhaps you'd like to comment as well.
Absolutely. I think in anything that we invest in, there is obviously a good amount of work that goes into. I think there's a bit of an echo. I can hear my own voice on the other side. But hopefully, let me see if I can get through this. Okay, so absolutely. So this risk evaluation and analysis is absolutely critical to what we do, because I totally second Francois' comments in terms of the fact that there are lurking risks out there which you cannot estimate. These will tantamount to reputational risks, which will tantamount to other risks that sometimes is difficult to foresee. So. Standard Chartered has been the chair of the Equator Principles, and this is obviously an institutional body of over 100 banks, where when we look at project finance and we look at things like investments into certain new scale, large scale projects, what are the common baselines that banks can agree on? I think that does cover a lot of the ENS factors. But just shifting away from that, I think just if I look at the broader bond markets, it's not a market where a financier like us would effectively end up holding the risk, but we would effectively end up syndicating the risk to investors, which is again an equally important part, because our bread and butter business is to ensure that investors get what they see from borrowers. And that layer of risk is managed again on two counts. One is our own framework, i.e. Standard Chartered's own principles of environmental and social risks, but also at a second level where there's a second party opinion provider or an independent review or verifier who have their own set of guidelines in terms of how they can call something green or something ambitious or above business as usual, etc. So there are various tags that you provide these projects with. So between sort of the bank layers as well as the layers of the external agencies, we do believe that it significantly reduces or helps mitigate some of the risks that we would have seen on some of these projects. But I think we still have some way to go in terms of, again, as I go back to my original point on harmonization of standards, because our definitions of risks can also vary across institutions, and that will keep varying till we are able to harmonize and agree on common definitions. So I think that sort of is one puzzle which we still need to solve for, which economies need to come together and solve, so that banks like ourselves are able to sort of, again, harmonize our practices with other banks that we deal with on a regular basis.
Thank you, Rahul. It's very pleasing to see these banks who are major banks of the world in harmony on this particular point. I'd like to congratulate them all. I've just been handed a bit of paper here with some good news, which is that we can extend the session by 5 minutes. Sorry, gentlemen. It's Richard who's told me that, so we were right on the target. And I'd like to throw open for maybe one or two questions from the live audience here. Would anybody like to speak up? I can't see very well, so you'll have to... Do you mind standing up?
Yes, sure.
Thank you. And introducing yourself first of all.
Thank you. My name's Miranda Barker. I'm the Chief Executive of East Lancashire Chamber, and we run a programme called RedCat, which does early stage R&D investment in low carbon technologies.
Thank you.
Thank you for being here today, all of you. As far as we're concerned, there are really 4 different things to do with green financing, and 2 of which you've covered, which are very much the setting of standards for banks in terms of their own scope 1, 2 and 3 move towards net zero, and obviously protecting your customers and those you invest in to make sure they are adopting those standards just for the sake of their survivability. But much more important, how do we get our financiers to really move together to advance early stage funding to support the development of new low carbon technologies? And how do we make easy finance available to all of our SMEs to help them adopt low carbon technologies and cope with the payback periods?
That's a great question, thank you. We didn't touch upon low carbon, the need to invest in low carbon technologies. So, gentlemen, would anybody like, Francois, could you answer that? Because you're in the live audience. Would you like to comment on the question?
So I think I do touch on 2 points. The first one is around financing to SME, and the second one is more in terms of financing project at a relatively early stage. And so I think that on the first one, if I look at what we are doing, for instance, in the UK, we are one of the biggest banks for all the SMEs, and so we have funds to finance SMEs. And so, of course, it has to follow the risk framework. We just discussed risk, but we do quite a lot of financing for SME. The second one, in terms of early stage financing, is at times a bit more complex, because quite often it cannot follow the normal banking model, where you take a certain percentage of risk that you can assess, and then you have a return to cover this risk. And here what you are talking about is perhaps something that will require a different source of financing if you cannot really assess, if it's a very early stage, how the technology will work. And so I think that's more like venture capitalist. And so there are funds for that, and so HSBC has developed one fund to actually participate in some projects, but this is normally not the same kind of funding that just the normal debt, that is more for established companies.
Thank you, Francois. So I might give Bruce the opportunity, and I believe that Jamie's raised his hand there, so I'll keep going until you tell me to stop, all right? And thank you for the question again. Jamie, you wanted to come in, and if you could keep the answer relatively short, please, and then I'll just give Bruce an opportunity as well.
Yeah, so just very briefly, the history of what we are doing. In 2009, I was the CEO of the Ellen MacArthur Foundation. We identified the circular economy as a huge investment opportunity. We could see lots of corporates moving this way, but also lots of earlier stage and growth stage companies who were struggling to be able to grow at the rate that they really needed to accelerate this transition and unlock the value. And that's exactly why we set up Circularity Capital. So our view is that actually these companies need something quite specific. They probably need a slightly different network. They need different insight in terms of what these companies are doing. And I think from an Indonesian context, that's something that, say, Forest Carbon has found as well, in terms of you need investors who understand these kind of companies. So it's good to see, I think, that there are a growing number of these types of specialist funds, particularly backing these types of earlier stage or growth stage companies coming into the market. And I think the other thing that's really attractive is this is only going to work if these types of funds deliver attractive returns, right? Let's be quite frank about that. They're not going to grow unless they deliver attractive returns. And I think there's increasingly good evidence that in certain instances, the right products are really outperforming, right? So I think there is a need for that. There's need for new product in the market, but also there is more product coming into the market now. So there's a good trajectory there.
Briefly, Bruce, you've just got the floor for the last 30 seconds, please.
Great. Very briefly, it's a great question. You know, clearly there's a lot of capital at the top end at capital markets, and we've covered that already. The mid-size, you're just starting to see now sustainability-linked loans. Those are for people and companies that haven't tapped the capital markets. We're working in that space, helping advise people how to get on that journey. But that is a new market. SME is the most challenging, clearly. I think we have to, for example, we have accelerator hubs around the country working with people starting companies. I saw one and talked to a business the other day using recycled fabric to start a business. So I think there's a real commitment that banks have to make, as we've made, to really focus on startups, money to startups, especially to groups like to women, other people who haven't been able to access capital early on. The SME bit is critical. We'll be launching an SME product later in the year, so look out for that.
Books out, gentlemen. We're all waiting for that. Those of us who run private companies anyway. Okay, thank you, everybody. It's been flashing red for some time now. I'd like to thank everybody for attending this session today, and look forward to discussing matters with you during the course of the COP conference. And keep going, the delegates. Thank you.
experts we heard from. Grateful to them all. Lots of food for thought. Please tweet away. Tell people about this on @Glasgow_Chamber, or give us your feedback on social media in the hop-in chat box. We'd love to connect with you either if you're here physically or if you're somewhere else in the world. We're going to have a very short break. Is that right, Richard? Is it minuscule? Are we doing a break? A mini break? We're starting here at 1:45. 1:45. Yeah. Right, so either stay here for Race to Net Zero or go to the Smart Cities room for your next one. But I think it's a mini break to get people to move to their next venue. But thank you very much indeed.